Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. Welcome back from the GW School of Business to George Washington University, right here in Duquesne Hall in Washington, D.C. Welcome back to anybody that's been watching the show online or listening on the podcast. Very much appreciated. If you're new, welcome to the show. As you know, many of you know if you've been watching. If you don't know, if it's your first time, we're going to be talking about companies. Typically, especially when I'm here solo and we don't have a guest, we're talking about companies, and we're going to use the GW Investment Institute investment framework. This is what our students do. So this is for entertainment and educational purposes only. Disclaimer to follow at the end as well. But this is how our students evaluate our approximately $10 million that our students manage. These are the endowment funds that are part of the broader endowment at the George Washington University. And our students do a great job, and they've been doing it for 20 years now. We started with one class. Now we have 4 classes and 5 classes and 4 funds. But today we're going to be talking about a single company called CrowdStrike, which is one of our holdings. Not a huge holding, but I think it's an important holding to talk about in the context of what's been happening in the markets around cybersecurity, where cybersecurity has been, a focus, but, the intensity of that focus continues to increase really because of what's happening in the markets, where this seems to be a more and more important industry. And I want to make sure that we talk about some of the companies. We spoke about Fortinet. Now we're going to be talking about CrowdStrike, one of our other holdings. Fortinet is a much larger holding in one of the portfolios. CrowdStrike is a not a tiny holding, but certainly not a large holding, but I think important for us to review. So if you're not familiar with CrowdStrike, the ticker's CRWD. What do? They do cybersecurity products and services to stop breaches for companies. And so, and one of the things you probably heard about is all of the airline cancellations associated with an update that happened through Microsoft. And so that was a huge problem, and the stocks really sold off. But that the stock has really come back now. And so I think if you look at that just as an example of how important this industry is. So even with, I would say, a blunder in this case, and whose fault it was, somebody would have to go back and really understand exactly what happened, and making sure that the blame is assigned properly. But certainly CrowdStrike played a role in that. There's probably no doubt about that. However, the market reacted. The stock really sold off hard. And if you look at the price chart from that, it just dove down. But it's gained all of that back and more now. And so it certainly seems like, well, if you just use that as a data point, that maybe would have sent potentially other companies out of business or sidelined them. But it doesn't look like it made a lasting impact on CrowdStrike on the downside. They have come back strong, and they are doing well. And I think part of that is the demand on cybersecurity, the demand for their products, and I think just demand in the industry overall. And again, we talked about Fortinet, which is a larger holding in one of our funds, but today it's about CrowdStrike. So let's talk a little bit about, what do they do? Again, cybersecurity, it's mostly delivered through subscriptions. So that's the vast majority of their revenue. And the breakdown for internationally is the U.S. is about 2/3 and internationally is about 1/3. And so that's important to think about. And when you talk about, okay, well, what's the revenue for this company? We'll get into revenue and market cap. And again, we're using the GW Investment Institute framework, as we talked about, business management, price valuation, and balance sheet. We're tackling the business right now. So what's the revenue look like for this company? So if you look at 10/31/2024, they're at $3.7 billion. In revenue, that's up 30%. So these are good growth numbers, and we're going to get to valuation. And then let's talk about what's the market cap for this company. And so when we talk about what's the size of the company, this is not a tiny company. We're not talking about NVIDIA or Apple or Microsoft here, but this is not a small company. $91 billion market cap as of early March here. And so, again, not a tiny company, but has been growing a lot. And we'll get to valuation right now, which is where some people think, well, maybe this is a challenge to think about on should you hold or sell, or certainly on the acquisition side. So we talked about the business. So cybersecurity is an excellent business to be in overall. They had this sort of very challenging situation that they came back from. If you look at the business growing at 30%. So let's talk about they're delivering things through subscription for the most part. 3.7 billion in revenue. Most of that's through subscriptions. 2/3 of that's in the US, approximately. So you're looking at, you can probably guess, if you've been following the show, that this company likely has high gross margins. And it does, 75%. When you're delivering things through subscription model, you're going to tend, and it's software-based, it's going to tend to have high gross margins because, the cost of production is low, right? It's software, and you deliver it over the internet. And so you have high gross margins, 75%, projected to actually go up next year. So now we're looking at net margins, and this is where it gets very different. You got net margins, and again, this is an younger business, of just 4.4%. Now, they're projected to get into the 20s for 2025 this year and 2026. And so you've certainly seen the business losing money, and then just start to break even and making money now, and then projected to grow those net margins. So again, they've had high gross margins, but they've had low net margins, and they've been trying to grow the company. They've certainly been investing in this business and trying to get this business to be profitable. And if you look at the CapEx that they've been putting in the business this past year, you're talking $200 million and free cash flow of $1.1 billion. So you would have to, say in general, this is a good business. It just turned profitable for the most part. So you wouldn't call this a cash machine at the moment, or it hasn't been rather, but you still have high growth rates. You have high gross margins, which is a good start. You're starting to get positive net margins, and you're projecting, 20% net margins moving into the future. So on the score of this, if you give 1 to 10, 10 being the best, you're thinking this is probably more like a 6 or a 7 right now. Again, the high gross margins, you would tip you thinking, well, maybe that's closer to an 8 or a 9. However, when you look at the net margins, where they are in the path of their growth over time, okay, not where we would like them to be, certainly not where NVIDIA is, or Visa, or Apple, or Microsoft, but they're growing, and they're certainly starting to turn the corner there, and you're thinking, 20% plus gross margins moving forward, which is fantastic. So that's the business. And I think we may come back to the business a little bit, but let's now move on to the M, which is the management team, and let's really talk about them. So we have George Kurtz, who's co-president, CEO, co-founder. So this is a founder-led business. So it's early days in the business, and this person still owns some of the company, but not a huge slug of the business. Let's say 2.5%, 3%. So still significant ownership, but not something where you're thinking, okay, 15, 20, 25%, 40% in the case. When you think about Oracle and Larry Ellison, and we talked about Fortinet, between the two co-founders, you had about 15%. So this is a much lower number than them. So it doesn't necessarily mean that's a bad thing, but certainly, our interests can still be aligned. This is a significant stake in a large company. It is a big company, but again, not where Fortinet is, not where Oracle is, certainly not where Berkshire Hathaway is. But again, not necessarily by itself a terrible thing, but that's the ownership, that's the management team and the ownership. Now, look, as we talked about at the opening, they had a very challenging time with this update, canceled all these flights. It was an upgrade through Microsoft from CrowdStrike, and it was basically a disaster. But again, the market really reacted strongly to that. It sold off hard when that happened, and has come back and is even higher than it was before that. And so this is something that tells you something about the management team. Their way to fight through this obviously is, they found a path through, and maybe they could have done it better or worse, but certainly they found a path through that. I think if you look at examples like that, where we have these very challenging situations, that says something about the management team. Can they navigate these very difficult circumstances? And they have. And again, the backdrop on the business side is that you have these tailwinds in this business, and the management team made a blunder. They navigated through that blunder, and they're on their way back. So they seem to have mended the fences there, and it looks like, powering ahead. So I think we like founder-led businesses at the Investment Institute, generally speaking. Not a huge ownership slug in the business here from Mr. Kurtz, but significant, substantial 2.5% as an example there, or for example there. We'd love to see more, of course, than that, but certainly not something where we're going to say, oh, this is a disaster or anything. And this person seems like they're trying to get out of the way. Not the case at all. Again, recent example, navigating through a very challenging situation with this update that did not work properly and canceled all these flights. Very public, very much scorned. Stock sold off hard, navigated their way back through that. Again, the backdrop of having this industry tailwind where cybersecurity gets more important every day. People are not going to say, well, we need less cybersecurity, at least not in the short term. It seems like the direction is one way right now: increased demand for products and services associated with the cybersecurity industry as everything becomes more digitized over time. And so their products in high demand, navigated through that. Co-founder of the business. And so we like that. Not a huge stake. So I think on the management side, you can probably give them somewhere in the neighborhood of a 6 or 7 right now. Time will tell where they go from here. I think it's important to note where they are in the cycle, just recently turning profitable for the company in the life of the company, and projecting 20% plus margins next year, and then into this year for the full year, and then into 26, 20, maybe close to 25% net margins. That's fantastic. So that would be great. When you start with the 75% gross margins, obviously that's a good business. And again, they're selling things through subscriptions for the most part. And that is a fantastic business. That's going to continue to have high gross margins. They're going to have to continue to invest in the business. But if you can get that net margin higher, I think that's going to be great for shareholders like us and other shareholders that are owners in the business. But again, they seem to have turned that corner. And that's also the kudos to the management team to navigating through that, getting them towards profitability and trying to turn the corner. Again, as shareholders, obviously we want companies and management teams to invest in the business, to grow the business. But we don't want to be unprofitable forever either. We want to, at some point, they turn the corner, and you think of big companies like Amazon who did that for years and years and certainly have turned the corner there. And CrowdStrike is doing that right now. And so I think those are good things. We talked about Spotify, who recently did the same kind of turn there, and Daniel Ek at the management team here. And here you have George Kurtz at CrowdStrike making the same sort of move for this. And again, not a tiny company, $90 billion market cap. And so I think that's, again, puts the management team in the 6 or a 7 right now. So let's move on to the valuation. And we interlace all these comments. These things are all interrelated: the business, the management, the price valuation, and the balance sheet. It's hard to really disaggregate them completely, but for the sake of trying to understand a company, trying to get through the framework and it be useful, you really try to extract these things and think about them individually and then put them together as well. So we overuse, which is, what we do here is the PE ratio. And here, because they've turned profitable, it is more useful at this point. But you're looking at almost 100 times, forward PE. That's a big number. And for some people, that's really challenging to get their head around of like, should we really be paying that much? If you overpay for something, it is a big challenge. And if you look at a company like we talked about, Fortinet, you're talking about something that's close to half of that for the PE. So, Palo Alto Networks, which would be another company out there, has even a higher PE. So there's a high demand in this, and people are willing to pay up for these earnings for these companies that are growing, and for some of the premier players, CrowdStrike being in there, 100 times. Now, if you overpay for anything, very challenging to make your money back over time. And when you're paying 100 times, you really have to expect that the earnings are going to grow. So to re-rate up from here, to go from 100 to 125 times to 150 times, that's not an easy thesis to make. But what you can say, okay, they're going to trade it 100 times, which means they're going to have to grow earnings. Now, they're growing revenue, as I mentioned, 30%. So that's going to that itself can propel them forward, and they're probably going to have to do it even more than that. And if they can maintain those super high gross margins, it's certainly possible to maintain a higher PE, but you're probably going to have some compression, meaning that the PE is going to come in. People are going to re-rate it down as the growth slows down. So you have to think about, okay, well, what's this company going to be worth in 5 years? Well, if they continue to grow it at 30%, certainly you're talking about a double just in a few years here. And so in revenue, and if, again, they maintain a high gross margin, they increase that net margin, you're talking about a lot more earnings that are coming back to the company. So they're really growing earnings. If you have some multiple compression, you can definitely still see that it's going to have to be rated much higher than a typical PE for an S&P 500 company, which you're talking now about 21 times forward. And so there's a lot of room between 100 and 21 for that compression to happen. But you have to think at least at this point with those high gross margins and increasing net margins that it's going to be at a premium, even moving forward to the S&P 500. Now, where that is when it starts to settle in a few years, if it's not growing quite as quickly, but still is doing well and is able to maintain those high gross margins and increase those net margins, well, it can still trade at 30, 35, 40 times. But that's something as an analyst we need to think about for the students at the GW Investment Institute. That's something that we want them to think about. And if you're playing along at home and you're evaluating companies, that's something that you need to think about as a business person, as an investor, thinking about what's the right target margin or target PE that I can put on this, given where their margins are on the gross, on the net projected out for a few years. But right now it looks a little bit expensive, but we have to decide what we're going to do from here. Is it a position we add to when you have pullbacks in the market? We're in early March here. We're having a market pullback right now. Is it time to add to positions like this? If you think it's a high quality business with a good tailwind, with a good management team, and the valuation comes down, that's when you either high grade your portfolio if you don't have new cash, or you add to this position if you have cash. Not saying we should do that. Certainly not investment advice here, but that's the thought process. You got to think about those things when it's time to either reallocate capital or to allocate new capital. Do these things deserve additional, or is it time, it's been a good run, we should trim? Again, that's the work that we have to do as analysts, as business people, to try to understand that. All right, so now let's move on to the balance sheet, and then we'll pull everything together. So if we talk about the balance sheet, as I mentioned, $90 billion market cap, cash and cash equivalents on the balance sheet, $4.2 billion, and $790 billion in cash, or debt rather. So let's call it 8. So you're talking over $3 billion in net cash, 3.2 billion just to round it, or 3.3 billion in net cash. So this is not something we're super concerned about, and they're generating free cash flow of $1.1 billion right now. So that, as balance sheets go, again, 3.3 billion in net cash as of 10/31/2024. So we're not like super concerned at all about this, and you're generating free cash flow of $1.1 billion. So that's more than the total debt, and certainly you have net cash to pay that. So really, really not a concern. And so you're going to give this, on the balance sheet. It's a pretty quick analysis for this. We're talking sort of a 9 for the balance sheet, not something that we're concerned about. Now, one of the things that we try to incorporate, we've done this before we give the sort of final score for the balance sheet, that's sort of a as is today or last reported, what has happened over time. Now, this is where we might say, well, we might ding the balance sheet just a little bit, even though they have net cash, because since 2021, the reverse, we might increase the score. It's hard to go up from a 9, but maybe it's a 9.5 or even a 10, because if you look at what has management doing, and this is where the management and balance sheet are very much connected because management runs the balance sheet. If you look at the cash over time from that period, 2021 to now, or the last reported in 2024 in October, you're talking about $2 billion in cash, and now you're at $2.2 billion in cash. And so they've increased that over time. So you've more than doubled the cash on the balance sheet, and the debt has effectively stayed at the same level. And so if you look at, okay, well, how responsible has management been with the balance sheet? You could say that they've been very responsible. They have really been conservative. And again, at the Investment Institute, that's the world we like. We like to sleep really well at night and be sure that as equity holders, we're not worried about the company not being able to pay its debt and go into bankruptcy. Remember, the biggest risk for any company is going out of business, bankruptcy, right? You don't live to fight another day. We want net cash on the balance sheet that helps us sleep at night during downturns, that helps us pick up market share, that's strength through the cycle. And so if you look at how this management team has performed over time, and we've talked about other companies in the same way, what's the last few years look like? What have they done with the balance sheet? Have they been responsible with the balance sheet? And here we can say, certainly they have been. They've doubled the amount of cash. They've kept the debt about the same. And so the net cash has risen over time. And if you look at what's the free cash flow done over that time period, you're talking about $300 billion approximately in 2021. And now you're talking about $1.1 billion. So you're really talking about 4+X there on the free cash flow, a double in the cash on the balance sheet, and the net cash jumping up from there without the debt really changing. And so that would be responsible management. And so you kind of possibly even give them 9.5, and maybe even this is a 10 for the balance sheet on the management. And so let's now pull it all back together. So we talk about the business. Overall, this is a cybersecurity company. We mentioned Fortinet, smaller, not a small position, but certainly not a big position in the portfolio, not yet. They have done well. Really good tailwinds in the business right now. Cybersecurity in high demand. If you talk about most of this is subscription revenue, and you look at how's the business done over time, they are growing. Revenue is growing at 30%, projected to grow close to 30% again, and 20% after that for 2026. So doing very well. Not really that concerned about what's happening there. 75% gross margins here. When you talk about, okay, well, what's the quality of the business here? 75% gross margins, recently turned profitable. So you're talking about single-digit net margins for last year, but projecting for this year, 2025, and the 24, and about 24 in 26. So very much turned the corner. So good business, good tailwinds in the industry. And again, demonstrated by this steep sell-off, demand has come back strong for their products and services, and it doesn't seem to have impacted them, even though they had this blunder and now connected to the management. So on the business, kind of 7 or 8 right now. Again, you would like to see them be even a bit more profitable. On the management side, again, we have a recent example, which is useful to talk about. How has George Kurtz and company, who's the co-president, CEO, and co-founder, how have they done? Well, when you have this really stark example of a big sell-off because of a very public blunder, it gives you a sense of, okay, there is a crisis. How is this management team, a specific crisis to them, not a market crisis, a specific crisis to them, to the company, an idiosyncratic risk, if you like, to the company. How did they manage that? They managed that fairly well. Maybe they could have done better, of course, but they managed their way through this, and now the market has appreciated the merits, the fundamentals of the company have come back. And again, you had a really steep sell-off, and people concerned about, what's the future of the company, or is this a lasting impact? It hasn't been. And so I think that, again, says something about the industry, the business, and says something about the management. But I would say, we'd like to have them a bigger stake, being a co-founder, 2.5%, not as high as we would like. And so probably give them let's say a 6 or a 7 there. Valuation, 100 times forward PE. Again, S&P forward is not is well below that, and this is a higher quality company than that. But you probably can expect some margin compression, and we'll see. So probably give this a 6 there. And on the balance sheet, again, you're kind of giving it a 10. So depending on exactly how you score all those, 20, we weight them 25% each. You're probably talking about a company that's solidly in the 6.5, 7. And again, depending on how we settle on all the different scores, but let's call it a 7 for right now for the company, but maybe a 7.5, depending on how we tweaked all the scores there. So 7 is good, not 9, but it's excellent. And some of the things, again, that we're challenging our analysts to think about is, the future for the industry looks great. The specific business looks like they're doing well, turning profitable. The management team solidly in place. We love the founder-led teams for the most part, not all the time, but many times. Good news there. Valuation, something that we have to monitor and watch. And on the balance sheet, super clean, net cash, growing the balance sheet strength over time, all good from that respect. And so as we wrap it up here, good outlook for the company. Again, about a 7. Good look for the management team. Industry very strong. Something about the valuation we have to really pay attention to is how high it is relative to its peers and relative to the market. We'll keep an eye on that, and our analysts will do that. Thanks for watching this show. See you back the next time on Market News with Rodney Lake. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.